I look back on how I got into private equity and I say it was pure luck. I actually started at Abbott Capital almost 20 years ago. So Abbott was my second job out of college. I didn't know really anything about private equity fund investing. I'd been working at a hedge fund trading stocks essentially, and I knew that I didn't like the short-term trading aspect of that. And so when I was looking around at what to do next, I came across Abbott and an opportunity to join the firm. And what I found when I got there was, working with a group of people that were really pioneers in the industry. Abbott was founded in 1986 by two practitioners that had been in the business for some time. And I was essentially the only junior person working with a team of managing directors. So when I got there, I saw it really was a wide open opportunity to really learn about the business. So as I said, that'll be 20 years ago in 2018, and so I consider myself very fortunate to have stumbled upon that. I joined the firm in 1998, so as you can imagine, it was quite different. We were sort of in the kind of internet boom just before the bust. So clearly there have been a number of different cycles, both on the venture capital side as well as the buyout side, because we invest across the spectrum in private equity. And so, in this business, time really helps as the fundraising cycles have lengthened and shortened. Having that longevity, it really helps to be able to just have pattern recognition and to develop relationships and be able to watch and observe investors over different periods of time. We don't try to time the market. That's certainly one thing we've learned over 30 years is that we're not smart enough to predict cycles and we're not smart enough to, call tops. But, we spend a lot of time looking at behavior and how people behave both in good times and bad. And again, since it is a long-term business and, cycles come and go and you can't always predict when a cycle is going to happen. We focus a lot on alignment and on culture. A lot of the due diligence that we do is focused on the people. We want to know who we are aligning ourselves with for at least 10 years, often more, because we hope that when we make a commitment to a fund, it could lead to a long-term relationship. And so understanding how people behave both in good times and in bad is important. We invest both on a primary and a secondary basis. On the primary side, we have, historically looked at about 500 groups a year. So that's sort of the top end of the funnel. And, we meet with at least, 200 to 300 of those. And on average, we probably commit to about 20 managers a year. Some years there's more, some years there's less. And again, it's been pacing about $750 million a year. So it's a real selection process. Abbott's philosophy has been to build fairly high conviction portfolios. So we really are only in a closed-end fund. We're looking to invest in about 30 managers over 3 or 4 vintage years. So it is a fairly narrow funnel from that perspective. And on the secondary side, the funnel is even narrower. We're, looking at $10 billion a year in deal flow to invest, between $50 and $100 million a year. So the funnel is even narrower. I think this speaks a little bit to the culture of Abbott. Our investment recommendations we call pro-con memos. So even at the point where we're making an investment recommendation, we go through all the pros and all the cons and ultimately come to a decision. Because with every opportunity, nothing is a slam dunk. And we always sort of kick ourselves afterwards if we come through an investment committee and it was unanimous and the table pounding. We sort of look around and say, what could go wrong here? So we have a very conservative culture. We're very focused on generating returns, but also managing our risk. And I think we're proud of our track record, both from a return perspective as well as what we view as real, real mistakes from the perspective of missing something in due diligence. To us, it's important to really peel back the onion and understand who is driving the returns, and then the relevance of strategy. Strategy is always often evolve, but we want to understand how the strategy evolves and why we think the strategy today is going to be successful going forward. What might have been successful in the past was interesting, but it could have been in a different market time. And so seeing how firms evolve, whether that means the addition of operating resources, whether that means more sector specialization so they can truly be focused and truly be experts, or just being able to clearly to articulate the strategy, and then for us to be able to utilize our due diligence to make the argument and convince us as to why we think this group is going to be successful going forward and to continue to be a strong performer. It's an interesting question, because if you look at Abbott as a firm, I'm certainly proud to be part of a partnership of 11 partners. 4 of us are female. So diversity is something that culturally has always been an important part of our firm, and it's interesting to watch the industry evolve and see, really, in the grand scheme, how little that's changed. But it's always been an important part of Abbott's culture, and it's something, certainly, personally, as a woman in this industry, I would like to continue to see change. It's something, again, we look a lot at culture of firms, and we look a lot at how decisions are made. And, if you have all the same people that, grew up together, went to school together, think alike, it calls into question, decision making. As we think about our decision process, not only the diversity of the individuals at the firm, in terms of cultural backgrounds, but also work experience. When you look at the backgrounds of the people that work at Abbott, they come from a variety of different places, whether it's investment banking, commercial banking, the Federal Reserve Bank. We bring a lot of different perspectives, and we have a very collaborative decision-making process where many of us are getting involved in the actual due diligence, the actual hands-on due diligence of each individual opportunity, and then making decisions, sitting around a getting larger each year table, and going around the room and starting with the most junior person and sort of going around the table. It's a real kind of apprenticeship model, and that was one that even I 20 years ago joined and have benefited from, and we're really trying to continue that.